Welcome to our video on understanding the repo rate. The repo rate is a crucial monetary policy tool used by the Reserve Bank of India, RBI, to manage the money supply and influence economic conditions. We'll simplify this complex topic with real-world examples, focusing on the Indian context. Our goal is to make it easy for everyone to understand. So, what exactly is the repo rate? In simple terms, it's a repurchase agreement where banks approach the RBI for cash. The RBI lends money to banks, using government securities as collateral. Think of it like pawning gold for a loan. Banks pawn their government securities to get cash. The rate charged for this transaction is the repo rate, which is essentially the interest on a bank loan. The RBI acts as the lender of last resort, maintaining financial stability in India. When banks need help and can't get money elsewhere, the RBI steps in. The repo rate plays a vital role in managing the money supply, especially during economic downturns. It helps stabilize the financial system by ensuring banks have access to liquidity when needed. But how does the repo rate impact you, the common person? When the repo rate increases, banks' borrowing costs go up. As a result, banks increase their lending rates for home loans, car loans, and other consumer loans. This means your EMIs become more expensive. Consequently, people tend to borrow less, leading to decreased spending and economic activity. Now, let's clarify the difference between the repo rate and the reverse repo rate. The repo rate is when the RBI lends to banks when they need funds. In contrast, the reverse repo rate is when banks lend to the RBI, parking their surplus cash and earning interest. Think of it like depositing money in a bank versus borrowing money from a bank. The reverse repo rate is usually lower. As of March 14, 2025, you can check the RBI's website for the latest repo rate figures. Recent changes by the Monetary Policy Committee are driven by factors like inflation and economic growth. The repo rate is adjusted to balance these economic indicators and ensure stability. So, why does the repo rate matter for the Indian economy? A higher repo rate helps cool down the economy by reducing borrowing and spending, which can curb inflation. Conversely, a lower repo rate boosts economic activity by making borrowing cheaper. This impacts economic growth, investment, and job creation, making it a critical tool for managing the economy. In summary, the repo rate is the interest rate at which banks borrow from the RBI. It impacts your EMIs and borrowing costs. The RBI uses the repo rate to manage inflation and economic growth in India. By understanding the repo rate, you can make smarter financial decisions. Do you have any questions? Thanks for watching, and don't forget to like and subscribe for more insightful content.